So let's talk about the 5 ways to buy real estate without cash or credit. And what I'm going to do is I'm going to go through these techniques fairly quickly here, because in this section it's not about knowing everything that comes up with a technique and how specifically to put every last step of it together. It's about understanding an overview of the different ways that you can buy property without putting any of your cash and credit into it. And then later on we'll get into another training where I'll show you how to know which of the techniques to use. Does that make sense? So, 5 ways to buy without cash or credit. Number 1, buying with cash and making sure this is what? Other people's money. When you're buying with cash, I'm going to share a quick, easy formula to make it simple for you. Number 2 is wholesaling a deal. And that's when you get it under contract, and without closing on the property, you sell your interest in the contract to another investor. Number 3 is buying subject to the existing financing. It's known as subject to. Again, we're going to go through that from a high level here. We could spend a couple of days. We actually got a course on buying subject to where it's 2 or 3 days of training, and we're not going to get into that much detail here, which is okay. We're keeping it at the level where we understand all the different opportunities here. Big money, cash close. We're going to get into talking about that. Number 5, owner carry. And what's life like if you don't get some extra special bonuses from time to time, right? So, bonus, number 6 method, is doing a short sale. All right? So cash, making sure it's someone else's cash, wholesaling a property to another investor, buying it subject to the existing financing, a big money cash close, owner carry, and a short sale. So let's just take a little bit of time here real quick and go through each one of those so we understand from a big picture perspective how you're going to use that from structuring a deal. Then again, in a later training, we'll get into how to know which one of these to use. First off, when you're buying for cash, it's very simple. There's a cash buying formula, which you should never pay when you're paying cash for a property more than, in a good market, 70% of what we call the as-is value. Now, the as-is value is very simple. It's the value of a property in its fixed-up condition, if it were fixed up, less the cost of any repairs. In a slower market, it's going to be 60% of the as-is value. We're more conservative in a slower market. As far as coming up with the cash, a couple different ways. You're familiar with hard money lenders. Having a line of credit that you've got access to, or if you do have the capital, or a friend with the capital, is another way to do it. So line of credit. And what did we just spend a lot of time talking about? Private investors. With a cash deal, the thing that makes a cash deal work is that you're coming in with all cash and you are closing quickly. If you're writing a cash offer, you're going to offer to close within 20, maybe 30 days at the very most. If you write a cash offer with a 180-day closing, they're probably going to find another way to sell it and get more out of it in the meantime. So, short closing, from 20 to maybe 30 days max. And you want to make sure with a cash deal that if you're coming in and buying it for cash with a hard money lender, for example, you've got very high what? Interest rates and points and things, but it's the interest rates that will kill you. So you're never ever going to go into a deal close on it with a hard money lender and then not work diligently to turn around and resell that property. With a cash property, if you're buying it for a low enough value, if you're buying it at 60% of value, is there a pretty good chance in any type of market that you're going to be able to sell it for more than that? Yes or yes? Are you going to try and sell it for 100% of value? No. You're going to turn around, take a good profit now, rather than trying to get every single penny out of it and finding out that that doesn't work. Now, a couple of points that I want to make on a cash deal. First off, a cash deal is a cash deal from whose perspective? So a cash deal, write this down. If the seller gets all cash, then from the seller's perspective, it's a cash deal. So if you bought a property this way, and it's not the way I like to buy them, but if you bought a property with 10% of your money down, and then you got a loan for 90% of the rest, from the seller's perspective, what is the seller getting out of that? All cash. Seller is getting all cash. In my opinion, it's just my opinion, if you do that, you should be getting what type of a price? You should be getting a cash price. I've had people come to me and they say, Peter, I've done a nothing down deal. I got the lender to give me a special deal, and I didn't have to put any money into it, and I bought it for $200,000, and I've got a loan on it for $200,000. Now, first off, is that property going to cash flow? No. Is that a safe, wise move to make, knowing that the market can have its changes from time to time? No. So understand that cash means all cash. And it's simple to do. I was talking with one of my students just a couple days ago, and she was talking to a builder, and the builder was willing to discount the properties $40,000 to $50,000 off of their original asking price, which we know doesn't count for that much, right? Appraisals, original asking prices, what it was listed for, I just ignore those. I think you should too. I don't care what it was listed for. What has a similar property like it sold for in the past 1 to 3 months? That's what's going to tell you what a property is worth. In this case, I said, great, the builder is discounting them this much. What you need to do is not look at what they were originally asking. You need to look at what it would sell for today. And if you're going to bring in all cash or a loan to buy the property, which is what the student was talking about, I said you need to get it at a cash price, 60% of value. If you can't do that, guess what? It's not going to be a cash deal. All right. Wholesaling, I'm not going to spend a lot of time on that because it's so simple. The one thing you do need to know with wholesaling a property is that you need to have the ability to assign your deal, and I prefer to have it written into the contract ahead of time. You can put it down when you write down your name. If I was doing it and I was the buyer, I could put Peter Conti, although I'd use an entity. And I can write in and or assigns, which does the job from a legal standpoint. But when someone is looking at a deal that you just signed up and the first thing they see is this blank right here, what are they thinking? When they see this and or assigns, what are they thinking about my ability to close on the property? Oh, he's going to flip this thing. I wonder if Peter has the ability even to buy this property. So I prefer to either have it pre-printed in there up here, or even better than that, what I like to do is I'll have an agreement where it's either down further in the agreement, or you can use a standard agreement, and then there's an addendum. I call it an addendum A, but you could call it whatever you wanted to. It could be addendum letter K, and it would work just as well. And what the addendum says is it says, in the event that anything in this agreement here conflicts with the printed portion of the big, long agreement, sometimes I get questions about whose form should I use, that type of thing. Obviously, I like using my own forms that we've developed. There's situations sometimes where, and we'll talk about this tomorrow with commercial, where it makes more sense to use the form that the seller's used to or the realtor's used to, not fight it, and then you staple your addendum. You put down here, addendum whatever, A is a part of this deal. You put that language down here in this agreement, and then this addendum starts off with this language. It sounds like this. This addendum, first it ties it in as a addendum to so-and-so deal between so-and-so parties dated in such date. In the event that any of the provisions of this addendum conflict with the contract to which is it attached, in that event, the things that are listed in this addendum shall prevail. What does that mean? It means that in your agreement, they can say anything that they want to. For the assignment clause, for example, this is not assignable, and it can be in big bold letters and highlighted and circled and everything in this agreement. And then in your addendum, it says, buyer may assign to an entity or company or individual as he chooses in doing it prior to closing. Okay? So you have it up front, and then you can just change it. And that's one of the things that's helpful when you get into agreements. So, moving on. Now, just to finish up real quick on wholesaling, the key to wholesaling a deal is making sure you're getting it at a good enough what? Price or terms that you have the ability to give someone else enough what? Enough profit so that they can get into it and then still have enough profit to do what? Sell it to someone else, yeah. And Jeff, if there's any clear overheads back there, it'd be great to probably have a few more of them up here. Okay, subject 2. First off, the reason that this is called subject 2 is when you buy a property this way, you're going in and you are buying the property subject to the fact that there's an existing loan in place on the property. So that's why it's called that. In layman's terms or mechanics terms, the way I would look at it is you're going in and buying a property and it's already got a loan on it. Rather than paying off that loan, you're just buying that property and leaving the existing financing in place. Thank you, Jeff. Now, you're not assuming the loan, because when you assume a loan, you go and talk to the lender and you end up getting down on your knees and saying, would you please let me take over this loan? And they're going to have you jump through hoops and fill out applications and pay fees and also what? Sign on that loan, right? When you buy it, leaving the existing financing in place, which is called what? Subject to. You leave the loan in place, yet you go ahead and buy the property. Now, the biggest concern that most people that people have, and I know I had it for years before I started buying properties subject to the existing financing, is, wait a minute, I've heard that there's something about a what? Due on sale clause. And there is a due on sale clause. What the due on sale clause says, if you as an investor come in and you buy a property and you leave the existing loan in place, you don't pay that off, which is how most people buy property, then the lender has the right to come in and say, wait a minute, somebody else owns the property, we have the right to call the loan due. That's the due on sale clause. It was put in place about 1989, I believe, because at that point in time, lenders saw where people were buying properties subject to the existing financing, and when you had a low interest rate loan, people were just passing them along subject to, and the lenders didn't get a chance to re-lend that money out at a higher interest rate. Now, in today's markets, and this could certainly change, in today's market, first off, when you do this, you're not breaking any laws. There's no law against buying a property subject to the existing financing. In fact, it's done every day on both residential properties. It's much more common on commercial properties. The lender does have the ability to call that loan due. However, if you come in and John is behind in his payments, 3 payments, and you say, well, John, I can buy your property, but I can't really get you any money. And John says, that's okay, I'm ready to walk away. Great. What you do is you make up those 3 payments. John's loan, which was turning into what type of a loan? A bad loan or a foreclosure, on the lender's books gets moved over to what? One of their performing assets again. Is that a good thing for the bank, first off? Yes. Would they prefer that that loan is on their good side or their bad side? Obviously on their good side. One of the reasons for that is a lender is required to keep on hand about 7 times the amount of money that the loan is in the event that it is going into default. It's through the federal banking guidelines and regulations. What can't they make on that money that they are then not able to lend out? The interest. So they have a financial incentive for not calling that loan due. Plus, with every single payment that you send in, what are you doing to the seller of that property? What are you doing to their credit? You're improving it with every single payment that comes in. Now, a couple of caveats here. First off, if someone bought a property this way and they didn't make the payments on that property, that would harm the seller of the property. And my recommendation is that you don't ever buy a property subject to the existing financing unless you would treat it just the same as a loan which you had actually signed on. Does that make sense? Because you want to make sure that you keep the seller whole, and you want to make sure that you perform on what you told the seller. I'm going to handle this for you. The other thing is that subject to deals can get very complicated. For example, when you buy subject to, you can sell subject to, and you need to use a wraparound mortgage to protect your interest and that type of thing. So make sure you get some help or someone that's done it before if you are going to be doing this. The other thing is some people go into all sorts of extra steps to hide the fact from the lender that they have taken over the loan. They're worried about the lender doing what? Calling the loan due, right? So they'll set up a trust and have the beneficiary and moving the cups around like this and make it difficult for the lender to realize that you've called the loan due. Let me share something with you. In the past 17 years of my investing and 12 years of teaching, with all the different people I've met and all the different students I've taught, do you know how many loans I know of that have been called due, subject to? 3. One of those was because the seller went to the lender and said, I want you to call this loan due. We found if you go to the lender and say, I dare you to call this loan due, guess what? They will call it due. Okay? Obviously, through that process, do you think we've learned some ways to make it much less likely to do that? Yes. And we're not going to get into that here in this session. So I like to keep it simple. I'll just take a check from my company. It's got my company name on it. I write out the date, not the date, the loan number, and the address of the property, and I send it in. When they're getting that check, are they getting one check or are they getting a lot of checks? Getting a lot of checks. Does the lender have the right to call the loan due, though? Yes. They do. Is that one of the risks in your portfolio if you're buying properties subject to the existing financing? Yes. It is. What, more than anything else, would probably, rather than the seller calling them up or that type of thing, would cause a lender to call the loan due? If the interest rate's what? Low. If the interest rate on the loan is low and the interest rates in the market do what? If they go up. So if interest rates are starting to head up, or if they're getting high, that lets you know that you need to, with these properties, either refinance the property or sell it out of your portfolio, even if it means that you're going to maybe take less money on it. The other thing that you have going to your advantage with a subject to deal like that is that subject to deal is, if they do call the loan due, it's not just they call you up and it's due the next morning. They'll send you letters and say what's going on and we need you to qualify, and if they do start the foreclosure process, depending on the state that you live in, it's going to take them a period of time to do that. In Texas, it's a month. In other states, it's longer than that. Texas, we joke about the sheriff coming to the door with his gun if you don't pay. So, all right. If you just hold that, I'll get that for you when we break in just a moment here, actually in about 10 minutes. All right, let's cover big money cash close. Again, so we know the concepts here. Big money cash close is something that works with a free and clear property. Anyone know what percentage of properties are free and clear in the United States? About, he's saying 30, both saying 35. Yeah, I was going to say 30, 35%. So there's plenty of properties out there like that. With a big money cash close, what you do is you take a property, and we're going to say that this property is worth $400,000. You come in on this property, and you get a new first mortgage of up to half the value. In our example here, nice round numbers, $200,000 new first mortgage. Is that a difficult loan to get? It's not a difficult loan to get because why? It's a low loan to value. It's 50% loan to value. The interesting thing about this is if you go and ask your mortgage broker if they would fund a loan like this, Well, I haven't told you the second part yet. The second part is going to be up here. The second part, the other $200,000, that's going to be a second that we're going to get the seller to carry with what we call soft terms. I'll share with you in a moment what I mean by that. If you ask a mortgage broker, would you give me a first loan for $200,000, and I'm planning on have the seller carrying a second for the entire value of the rest of the property, what they will tell you is, no, we don't do loans like that. Because they want to make sure that they're not getting into a situation where if you didn't have the special terms on this loan that I'm going to share with you, most people, if it was 100% financed like that, they would what? Be paying too much in payments, negative cash flow, and it's a recipe for disaster. However, what I found is that if you put a deal like this together, and rather than going to a mortgage broker and saying, if I did this deal someday, would you be able to fund it? If you have the contract in your hand and you call up the mortgage broker, and who's going to be our mortgage broker down here? Linda's the mortgage broker. And you say, Linda, I know you don't typically do deals like this, but I've got one under contract here, and would you possibly take a look at it? It's a little bit of a different deal. We're getting a new first mortgage for what? $200,000, 50% loan to value. Does that perk Linda's ears up a little bit? Yes. Yeah. And I do have to tell you, Linda, we are having the seller carry back, well, all the financing above that. It's okay. We've got some special terms that I think it'll make it okay. And I know that your lenders don't typically do that. But would you mind checking around, seeing if maybe any one of them might possibly want to take a look at this deal? And we're ready to close basically pretty quickly on it if they want to move on it. What happens is they come back and they say, we found someone that's going to fund it for you. Now, does that work necessarily with every single mortgage broker? No. But you need to know that that's the process that you go through, because when you ask somebody, would you fund a deal like this, they'll tell you no up front, and we found that you can. I've had students fund them with their credit union and different banks and things. It's a process to go through. With the seller second of $200,000, you're going to get what we call investor-friendly terms. Now, first off, what would be the best terms that we could hope for on something like that? If we were buying a property, it would be, well, it could be interest only. How about one payment due in 5 years of $200,000? Okay, would you like those type of terms, Peter? On a deal? One payment in 5 years? Yeah. It's no interest. Is that something that you get people to agree to on a regular basis? No, but we're talking about investor-friendly terms. Let's come up with something that's very friendly to start off with, okay? Number two, rather than interest only, what we do is we get thank you payments. And the way you get a thank you payment is you say to the seller, well, let's see. We need to figure out what the property can afford to pay. We've got the new first. The payments are, and you don't have to get them exact, payments are going to be about this. Taxes and insurance is going to be about this much. The oversight of the property, maintenance and repairs is probably going to be about this much each month. We need to make a small profit, so $100 a month for a profit for us. And you're going to get up to a number, whatever that number is. Are you with me? Then I ask the seller, or if you know what properties are renting for like that in that neighborhood, you look at what the property is renting for versus all of the costs that you're going to have in the deal. And you say, obviously, the property needs to be able to afford to pay for itself, and you come in at a number that if there's a little bit left over up there, that's what the seller's going to get as a thank you payment. So it might work out to be, depending on the property and that type of thing, let's say it's $250 a month. If you looked at that payment of $250 and ran it through a financial calculator, I will tell you that the interest on that is going to be very low. Typically in the deals we've done about 2, maybe 3%. We don't like to talk about interest, though, because when you get into interest, people are doing their calculators and they're thinking that somehow they should get more for that. If someone has equity in their house and they can't sell their house, how much interest are they getting on that equity? Nothing. So people have an idea of say, oh, well, I have to get X amount of interest. No, you don't. You're not getting anything now. What we offer you is more than what you're getting. Make sense? So that's a thank you payment. Number 3 is what we call graduated payments. Now, we had a seller that we put a deal together with, and he looked at it, and we were trying to do the thank you payment thing, and his accountant looked at it and said, oh, well, you're not getting enough interest on this. You have to get higher. And we need people like to listen to their accountants, right? So what we said is, well, that's fine. Let's figure out what we could do. We talked to the seller a little bit. We said, well, Mr. Seller, in year number 1 and 2, what we'll get you is we'll start off with 2% interest, and you go through a whole discussion of how, as an investor, the property needs to be able to afford to pay, and let you get in and fix up the property and increase the value over time. Years 3 and 4, you pay 4%. Years 5 and 6, 8%. Now, first off, are you going to have a positive cash flow, assuming you structured this deal correctly in the beginning? Okay, so this is good. Are you going to be okay in the next chunk after it goes up to 4%? Probably. How about up here? Is that going to work with a higher interest rate? Probably not by that point in time. So your goal going into this is to be refinanced or sold out of the property before you move up into the higher interest rates. But what we found is the fact that you've structured it like this allows the accountant or the owner to look at these numbers and come up with however they want to run it through their Excel sheet or their calculator or whatever, and they'll come up with a blended rate. In the case that I was telling you about, it ended up being like 4.81 or something like that is what the accountant came up with. Now, does the accountant and the seller, do they know that you could sell the property before that and effectively have a lower rate than that? Sure, they can figure that out. In fact, the seller hopes that you turn the property around before that. But it's a way to allow them to win, and when they do get into the interest rate discussion, how to put the deal together so it still works with you. I'm glad you asked the question about that, Bo, because that's a critical factor with a big money cash close. Let's move on to talk about an owner carry deal. Owner carry deals, when you put them together, I'll tell you about a quick one that we did. We had a property in San Diego. It was a $600,000 property. And we were talking to the owner. His name was Al. And one of the things that Al said is he said, yeah, there's all these investors coming by, and they're coming up with these crazy different offers. And we said, really, what were those offers like? And he told us about some different things. We kind of found out what he liked and what he didn't like about those offers. And Al was a real estate agent himself, but he refused to list the house with any other real estate agents. And he had a house already in a retirement community that he was planning on moving into, and he was ready to do a deal. And we were talking to Al, and we said, well, what are you going to do from the money when you sell your house? Oh, I need all my cash. Great. What are you going to, will you go, invest in all lottery tickets? I find sometimes if you get a little bit ridiculous, it gets people to say, oh, no, I'm not going to do that. Well, what are you going to do with it? Well, I'm going to put it in the bank, is what Al said. Great. What kind of interest are you going to get in the bank? And at that point in time, it was, I don't know what it was, somewhere between 4, 5, 6%. It was within that range. And we said, great. If there was a way that we could get you that same thing, that if you sold your property the way you were hoping to sell it, and it hasn't sold that way, if we could get you that some other way, is that something we should be talking about, or probably not even worth our time talking about? So what we ended up putting together with Al, in this case, it was, whoops, I'm writing a dollar sign there, 10% down, and the balance of that was, the 90% was at 5% interest. Okay, is that a good deal? Okay, does it make you feel any better if I tell you 3 years later we sold it for $940,000? Does that let you know the outcome? We had an investor, it was actually one of our students that we went out and signed this deal up with. And our student looked at it and, oh my goodness, the house, and this big, and it had a waterfall out back. It was a nice house. Our student got scared. He said, even though he knew he had the opportunity to have this deal for himself, he got scared. He said, no, I just, why don't you guys just take it? I completely don't need anything that and he was out of the deal. So he missed out on a good deal, in my opinion. Real quick on owner carry. Owner carry, when it doesn't work, What makes this work, by the way, here with an owner carry deal? Why is that working? Yeah, the 5% is working because that's what the owner wanted, but you as the investor, you've got a property that makes sense because of the numbers that are going into it. Let's say that someone, and I get students from time to time, great, I have someone that'll do 5% down, and the owner's willing to carry the balance, 95% of the balance, at 10% interest. Is that a good deal? I wouldn't buy that property. Not in a heartbeat. Even if it was 8% or 7% interest. The payments are going to be too high. There's no reason to do that. There's really no reason to do that. Last thing I'll tell you real quick about owner carry, and then we're going to move on to our last bonus method, which is short sales. With an owner carry note, the property I bought one time, I bought the property for $69,900, and it was 10% down, owner carry, 7.5% interest. We did some things at closing, some credits and closing on the third and that type of thing. We actually got it down to $3,500 to close the deal. The seller started with a note of, in round numbers, about 60 some. Let's say I owed him $60,000 at this point. Along with that payment every month that I sent to the seller, I included a little note that said, if you ever want to sell this note, please let me know, I'd like to buy it. When you're buying a stream of income like that, the one risk that people have when they buy notes is what? If the payments don't what? The payments don't come in. If you're paying on a note, are you pretty sure that the payments are going to come in? Pretty sure, Bo says. Yeah. So, and I'm just rounding off the numbers here, obviously, to make the concept easier. He called me, he said, Peter, would you like to buy the note? And I said, yes, I would. And he said, great, when do you want to do it? And I said, give me a couple days, I'll call you back, because I didn't have the money, right? I found someone, a private lender, that put up the money and got a $10,000 discount on the property just by being willing to discount a note. One of the things I love about owner carry financing is if you can put that balloon date out far enough, at some point in time, you're going to have an opportunity, most likely, to be able to cash that note out at a lower amount. Now, banks don't do this, but owners do all the time. Particularly if you're working with an elderly seller and you can structure the deal where you let them know that their kids are going to get a great return and in 10 years they'll be able to get X amount of money. Well, if the seller should pass on and the kids who are never interested in real estate, are they okay with the monthly payments, or they want what? They want cash, and they're going to get a lot less, which is a good thing for you. And again, we're not going to get into all the formulas and that type of thing here. All right, last bonus way of buying property is a short sale. And I know we've talked a lot about this here, so I'm not going to spend a lot of time on it. Short sale is where you've got a property like this. The loan on the property could be just a little less than what it's owed. Sometimes it's even more than the property itself is owed on the loan. And as an investor, you go to the lender and you say, Mrs. Lender, by the time, what's going to happen is this person is behind their payments and you're going to have to foreclose on the property. By the time you take this property back and go all the way through the foreclosure process with all of your costs and fixing up the house, and here's some photos of how it's not in great shape, and the legal fees and the reselling it, brokerage fees and that type of thing, by the time you go all the way through this process, you're going to end up getting this much money. I'm showing about, in this case, what is that? Maybe 60, 70% of the value of the property. And what I'll do as an investor, Mrs. Lender, is I'll get you cash to buy this property, and we'll close in 20 days. Now, 70% may not sound like a great discount, but if you've got a $400,000 property, what is 70% of $400,000? How much is it? $280,000. How many of you have had a property that was worth $400,000, even in a slower market, and you could buy it for $280,000, knowing that you had the source of funding? How many of you think that even before you had to close on it, you think you could maybe sell that for what? $290,000, $300,000? The value of the property is $400,000. You've taken the loan could be for $420 up here. It doesn't matter. You're getting the lender to accept less than it's owed. One caveat with this, and again, we're not going to spend a lot of time on it here. You're going to hear Phil talking about this. The seller can't get any money out of the transaction. The reason for that is if the seller's taking a big hit on this up here, they're not going to want the seller to take a hit on it. And there's some changes in the laws and things that make this even more attractive, and Phil will actually be going through those tomorrow morning with you. And there you have 5 ways to buy without cash or credit, with an extra bonus, number 6, for you there.